too stressed with financial success. Come progress with America to achieve your financial success.
Hi guys, Rhoda Melvin here with Tuesday's tax tip. Today's tip is on distributions from your retirement account. Early withdrawal penalty. A distribution from a traditional IRA or a 401k before the account owner reaches age 59 and a half will cause a 10% early withdrawal penalty on the amount distributed. This is in addition to the amount of taxes that you have withheld from the distribution before you actually receive your check or direct deposit. Now, at age 70 and a half, the IRS requires a traditional IRA or a 401k owner, unless you're still employed by the employer of the 401k, to begin taking distributions from your account. These distributions are subject to tax, and the account owner will receive a 1099 for the amount that they had distributed that will be included on your tax return. Now, when you're planning to take a distribution from your account, take into consideration when you're going to have the amount of money distributed from the account. If you're taking a large amount, try to separate the amount that you're taking out into 2 years. An example would be, say if you're going to have $50,000 withdrawn from your account that you need for a specific project, try to take it out in 2 separate years. You might want to take out $25,000 in November or December, and then take the other $25,000 out in January, because if you take the entire $50,000 out in 1 year, this is going to have an impact on the tax bracket that you're going to be taxed on at that particular time for that year. Now, I'm not saying that this is going to be easy. It will take some strategic planning. This is why it's very important that you contact your accountant or give us a call so we can help you plan your budget for the year. Most clients ask how much money should they have withdrawn from or withheld from their distribution. Understand that most distributions from an employer's 401k or pension plan, and that's including solo Ks, before age 59 and a half, will be subject to a 20% withholding that is sent to the IRS in anticipation of the taxes and penalty that will be owed. This 20% is not giving any consideration to your overall financial status. You may have other sources of income that also need to be considered, and it may be you may be required to actually have more than just the 20% withheld from that distribution. So you definitely want to speak to your accountant or give us a call. If you have tax losses, consider converting to a Roth IRA or a Roth 401k. When you have tax losses on your return, you may want to consider using those losses to offset income that would arise when you convert a traditional IRA or a 401k to a Roth account. Whenever you convert a traditional account to a Roth account, you must pay tax on the amount of the conversion. So you ask the question, if we have to pay tax on the amount of the conversion, why convert? There are several benefits to having a Roth IRA than a regular traditional IRA. While traditional IRA owners must take a minimum required distribution when the account owner reaches age 70 and a half, the Roth IRAs are exempt from that requirement. That's a great perk and allows you to keep your money invested as long as possible. Now, Roth IRAs are not to be confused with Roth 401ks. A Roth 401k designated accounts are subject to the required minimum distribution. I know this is confusing, but since Roth IRAs are not subject to the RMD, such as the tax code, how can you avoid this? Simply roll over your Roth 401k funds over into a Roth IRA when you reach age 70 and a half. Distributions of contributions are always tax-free. Distributions of contributions to a Roth IRA are always tax-free. Regardless of your age, you can always take a distribution of your Roth IRA contributions without penalty or tax. Now, lastly, if you're over the age of 59 and a half and you want to take distributions from your Roth IRA, not only of the contributions, but of the earnings made on the account. In order to take a tax-free distribution from a Roth IRA, you must be at least age 59 and a half, and you must have had the Roth IRA for at least 5 years. As long as those two criteria are met, all of the amounts, contributions, and earnings may be distributed from the Roth IRA tax-free. If your funds in the Roth IRA are from a conversion, then you must have converted the funds at least 5 years ago, and you must be at least 59 and a half or older in order to take the tax-free distributions. Now remember, Roth retirement accounts are a tax-efficient way to earn income in the U.S. As a result, it is best to distribute and use other funds and assets that are at your disposal before using the funds that have been built up in your Roth account, as those funds aren't as tax-efficient while invested. Okay, guys, just to recap, 3 things I want you to consider when withdrawing or taking a distribution from your retirement account. Please speak to your CPA, your accountant, so he can help you or she can help you determine how much you want to withdraw, when you're going to withdraw, and if you need to withdraw or convert the type of retirement account that you have. If you have additional questions, click on the link below and we'll answer them for you. Hope to see you soon.
Come progress with America to achieve your financial success.